Hello everybody, it is Michael here from My Retirement Trading, and today I had the pleasure of interviewing Will Rhind, founder and CEO of GraniteShares, and he talked in depth about the YieldBOOST funds, and he answered any question I asked him, and he was a pleasure on and off the screen to talk to. That being said, let's get into it.
These are funds that generate high yields or high amounts of income. In the YieldBOOST range, you're looking at, on the low end, about 50% per annum in terms of annualized income or distribution yields, up to 150% on the high end. You're talking about a very large amount of income that's able to be distributed.
Hello everybody, it is Michael here from My Retirement Trading. And today we have a very special guest. But before we get into that, I must state that this is not financial advice or a recommendation, and it is for entertainment purposes only. With that being said, let's welcome our special guest, founder and CEO of GraniteShares, Mr. Will Rhind. Welcome to the channel.
Thank you, Michael. Thank you so much for having me. Pleasure to be on.
Thank you for being. Can you tell us a little bit about yourself and your company, GraniteShares?
Yeah, absolutely. So I'm originally from Scotland, but I moved to the US a number of years ago. So now I live just outside of New York City. But we have lived in New York City for the last 15 years, but now living in one of those sort of Connecticut suburbs. I am the founder of a company called GraniteShares. We are an asset manager that specializes in creation and management of ETFs, so all things exchange traded. I started the company 8 years ago, and we've grown the business pretty steadily since then. So now we're a global firm. We manage just over 12 billion in terms of assets under management. We have US listed ETFs, European listed ETFs, and we have a team in Asia as well. So we're active all over the world, and we have buyers for our ETFs all over the world. And you can think of GraniteShares as offering what we like to think of as high conviction ETFs for high conviction investors, which really is a spectrum of products ranging from everything from physical gold to leveraged ETFs on single stocks, to the products that we'll probably talk about most today, which is our YieldBOOST high yield options income ETFs.
Good, that's very interesting. Let's talk about your YieldBOOST products.
Yeah, so YieldBOOST is a family of options income based ETFs. And as you know, Michael, this area of the market is very popular with investors. Reason why it's popular is because some of these products, and YieldBOOST is no exception, the sole objective really is to generate high amounts of income. So these are funds that generate high yields or high amounts of income. And just to give you an example, in the YieldBOOST range, you're looking at, on the low end, about 50% per annum in terms of annualized income or distribution yields, up to 150% on the high end. So you're talking about a very large amount of income that's able to be distributed. And these funds pay on a weekly basis, which is, again, a very popular thing with a number of investors who seek to invest in these types of funds. So very precise instruments designed for manufacturing income. And they do that by selling options contracts. And so by selling options contracts, you generate something called a premium, which is what you receive when you sell the option. That is the basis or the amount of money that you can use to distribute out to your investors in the form of income. And YieldBOOST ETFs really have a couple of things that set them apart from other strategies out there. So number one is they're not covered call ETFs, which is a very popular category. YieldBOOST ETFs do something called a put spread, but put simply, that is selling put options strategy and buying put options. So they address two things. One, they sell put options, which is an efficient way to generate income. And then the other thing they do is buy put options to help offer or protect the downside, which is something that a lot of covered call ETFs don't do. And then the last point is, how do yield boost ETFs generate so much yield? Well, we sell put options on underlying leveraged ETFs. And so the reason for doing that is because if it's a 2 times leveraged ETF and you sell an option on a 2 times leveraged ETF, you have 2 times the premium as if you would do it on an unleveraged underlying, like the stock itself.
So what kind of investors are these products intended for?
So these are for any investor who's looking first and foremost for high amounts of income, or to generate a lot of income and to have weekly distributions. They're for investors that are looking for number one goal of income and are looking to generate as much income in the portfolio as possible.
And how are they intended to be used?
So these are intended to be held as long-term income investments, just like anything else in your portfolio. So again, the beauty of an ETF is people can buy and sell whenever they want, and people will have different motivations for buying and selling products at different times. However, these products are really just designed to produce income on a weekly basis. So I think for a lot of our investors, these would be long-term core holdings in the portfolio.
So you're saying that they're designed to be buy and hold products?
Yes, sir.
Okay, very good. Let's talk about NAV and does it matter on these funds?
Well, of course it matters. NAV matters to all funds. I think that the way that this gets explained, or perhaps it's one of the things that is a little bit misunderstood. So to put simply, the way that yield boost works is that if the underlying goes up during the week, then there will be no decrease in the NAV. If the underlying is flat during the week, there will be no decrease in the NAV. So therefore, the only way that the NAV can decrease is for the value of the underlying to go down during the week, and specifically go down by more than the proceeds of the distribution. In other words, more than the weekly distribution amount. So that is really, I think, the kind of misconception that people have, is that the NAV going down is linked to something else other than just the value of the portfolio falling because the value of the underlying stock or whatever has fallen during the week. The other thing that people can tend to do is not account for the total return of the product. So sometimes people can look at the price return, and the price return, all things being equal, will go down over time, because the main objective of the fund is to distribute on a weekly basis a substantial amount of income. So if you don't factor that into the total return, then again, it will look like the price is going down over time. But I think the main thing to take away is that the NAV is important, of course, just like in any fund, but the NAV falling as a result of anything else other than the underlying going down is something that these particular funds have that's similar to anything else.
So this is the type of fund that I'm asking, like, since it pays such a high return, once you get your original money back, then you can just like let it sit there forever and grow income.
Yeah, and you're probably familiar with a lot of these people, Michael, online that have spreadsheets that they've put together that essentially map out exactly that. So they have the list of yield boost products, they have the distribution amount, the annualized yield, and then they have a number of months to break even. So based upon the last distribution amount, their spreadsheet might say something along the lines of, for any given fund, it might be, let's say, 6 to 8 months before you get 100% of your principal back. and then the rest of it you're just taking income from the fund. So that seems to be the way that a lot of people look at these, and are able to sort of hold these longer term.
So what are your thoughts on drip?
Well, going back to your question about NAV, the one way to do something about the NAV falling is to reinvest the distribution on a weekly basis. So clearly, if you take the distribution and you invest it elsewhere, then the NAV will fall by the amount of that distribution, leaving aside the fact that the underlying may go up or down. So if you want to drip, or if you do drip, then you're putting the proceeds back into the fund. You're following along effectively with the performance of the fund. So that's one clearly way that you can combat having the NAV fall by the distribution amount, by reinvesting.
So what would exactly happen, you think, if you took all the distribution?
Well, if you took all the distribution and spent it, or invested it elsewhere, your fund value, your NAV, would fall by the distribution amount in that week, absent the underlying moving. So let's just say the underlying was flat and did not go up or down, just remained the same, then your fund value would fall by the distribution amount, because all we're doing is we're paying out or distributing that amount to investors.
So what is a big misconception people have about these funds?
I think there are probably two. Maybe you can put in three. Number one is, I think, and most importantly, this is unique to YieldBOOST, because YieldBOOST is really the only strategy out there that does this. With YieldBOOST, the misconception would be that YieldBOOST funds are leveraged ETFs themselves. I think this comes from the fact that we sell options on underlying leveraged ETFs, but the funds themselves are not leveraged. In other words, we sell an option, we buy an option. That's the strategy. It just so happens that the underlying that we do that is leveraged, but we never hold the underlying. So the YieldBOOST ETF itself is not leveraged. And furthermore, depending on what period you look at, you can see realized volatility figures for the YieldBOOST ETFs that might actually be lower than the underlying stocks that they ultimately derive performance from. So that would be the first one. The YieldBOOST ETFs are not leveraged. The second thing is around, I think, the taxation of the distributions. And this would be the comment that you might hear every now and again, that somebody would reference, and I'm paraphrasing, all you're doing is getting your money back through a weekly distribution. And that's people that fundamentally don't understand the concept of return of capital and the classification of a distribution as return of capital. So it's purely a tax construct, has nothing to do with the fund over distributing. Typically, you see this in funds that are promising a targeted yield. So a fund might say, we are targeting an annualized yield of 15% per annum. And if they have a bad month and the portfolio is underperformed and they don't have enough cash to make that distribution, they might sell some assets in the fund to make sure that they achieve that annualized distribution of 15%. Now, that's called a bad return of capital. And that's not what's going on when it comes to the YieldBOOST ETFs. The YieldBOOST distributions are taxed. If they're taxed as return of capital, that is a good tax efficient outcome. In other words, that is not subject to income tax and adjusts your cost basis. So that would be probably the second misconception. And the third misconception, maybe if we can call it a misconception, we touched on it already, but this idea of the NAV erosion, which was very popular with one of our competitors. And that, I think, comes from the fact that when you buy a covered call strategy, which YieldBOOST ETFs are not, there's no downside protection. So all you're doing is capping your upside in the form of a distribution, but you maintain 100% exposure to the downside. So with YieldBOOST ETFs, we designed them to be different. And we have the same concept or similar concept in terms of selling an option to generate income. but we also buy a put option to help protect against severe downside movements. So I think that's probably the third misconception, to the extent that is this concept of the NAV or NAV erosion and why and how that occurs.
Makes sense. Can you talk about a couple of tickers like maybe TSYY and XBTY, please?
Yeah, no, absolutely. So TSYY is the YieldBOOST Tesla ETF. And YieldBOOST Tesla, just like all the others, executes a bullish put spread strategy on an underlying 2x leveraged Tesla ETF. So there are different 2x leveraged ETFs on Tesla in the market, including one from GraniteShares, which is our TSLR, which is GraniteShares 2x leveraged Tesla. So it's our job to find options that represent, the best amount of yield and liquidity. We sell a put option on the underlying 2x leverage Tesla to generate the options premium. And then from that, we buy a put option on, again, the same underlying, the 2x leverage Tesla ETF. And that provides some downside protection. And that's your put spread structure for the week. So you receive the premium net of the underlying downside protection in the form of the purchase put. And that's on an underlying 2x leverage Tesla.
And then XBTY?
XBTY, very similar in terms of structure, but with XBTY, this is on Bitcoin. So there's a 2x leverage Bitcoin ETF as the underlying. And again, bullish put spread structure, selling the put options on the underlying 2x Bitcoin ETF, simultaneously buying a put option on the 2x Bitcoin ETF to help protect against downside. So that's the bullish put spread. And that's on Bitcoin, not on a cryptocurrency stock.
So is there any new products that you have coming out that you're allowed to talk about at this time?
We do. So if you look at the filings of YieldBOOST online, you'll see that there are a number of different products that are already effective, and we're trying to bring products to market as sort of quickly as we can. But there's a lot involved in terms of managing those products, bringing them to market. But nevertheless, we're expanding at quite a rapid pace, and hope to bring some more products between now and the end of year. I think the biggest thing at the moment, in addition to the individual funds that we get asked for, is some kind of YieldBOOST fund of funds or a diversified YieldBOOST ETF. And so that's something that's in the works.
Fund of funds, that I hear a lot of people talking about that online. Fund of funds by YieldBOOST. So that's good to hear. One last question. What do you think about Bitcoin, and are you bullish on it?
So I come from a gold background. I've been involved in gold for a number of years, been a great part of my career, and we still are very much involved in gold. GraniteShares is probably one of our biggest funds, is our BAR ETF, which owns physical gold. So I do like Bitcoin, and I am quite bullish on the prospects for Bitcoin. And a lot of that comes from my background in gold and the thinking around why someone should own gold in the first place. And I think that what I like about Bitcoin is the parallels that it has with gold, namely that it is an asset that's outside of the traditional monetary system. It's not stocks, it's not bonds, and it moves differently or is non-correlated to traditional assets. And in a world where governments are printing money in the form of debt, and there doesn't seem to be any sort of real efforts to rein in spending, these assets, a gold and a Bitcoin, are something that the supply can only be increased a finite amount. And therefore, that helps with this sort of store of value sort of argument. So Bitcoin is definitely a bit more volatile and a bit more speculative than gold. But nevertheless, I think that it's an asset that is here to stay and, warrants consideration in terms of the role in the portfolio.
Well, that's all I got for today. I'd like to thank you for coming on to the channel and I learned quite a few things from you, and I really appreciate your time. And I hope that this helped the audience. Thank you for coming on the channel.
Thank you, Michael. Great to meet you. Thank you for your time. And if anyone in the audience has any questions or anything, please feel free to reach out to us over at GraniteShares on X or on the website.
Thank you all for watching.